Why do our clients buy muni bonds? Because they want to sleep at night, they want to wake up in the morning and know that their portfolios are solid. Ultimately, the biggest concern for me, what keeps me up at night in muni bond land, is unfunded pension liabilities. Illinois' pension fund is only 40% funded. New Jersey is 49% funded. The metric is that if you're at 80%, actuarially, that's considered healthy. When you're half of healthy as a major borrower in the municipal bond market, it is cause for concern. So I got into the bond business 25 years ago. After graduating undergrad in finance, I decided that I wanted to do something for 3 years after graduating college. And so I figured I'd go to law school. I finished up, became a member of the bar, but along the way, I discovered bonds. I read a book called Liar's Poker by Michael Lewis. And Michael Lewis has written a bunch of movies, The Blind Side, a bunch of other exciting stuff. And Liar's Poker was one of the first things that I had read by him. And it was really interesting because Liar's Poker was a story of bond trading on Wall Street in the 1980s at Salomon Brothers. And it was sort of a warning from Michael Lewis, or I learned later on that he wrote the book for people not to go into bonds and Wall Street. And for me, it was almost a calling. I read the book. I said, I must have misread it completely or misread the message, because for me, it was an instant draw. So by my third year of law school, I figured I have to get into this Wall Street. I don't know anybody. I was a lower middle class kid growing up in Massachusetts. Went to UMass Amherst, finished law school at University of Miami Law, and I had to get into this Wall Street thing. But now, I guess I'm a bond nerd or a bond baddie, bond master, I don't know. But I'm having a great time, 25 years of doing this. I'm focused entirely on wealth management for family offices, small institutions, big institutions, registered investment advisors, high net worth individuals. Municipal bonds are the building block of our nation's infrastructure. Roads, sewers, tunnels, highways, public schools, they're all built by municipal bonds. They are the vehicle that finances the construction in the US. They're essentially loans, an IOU. Why does somebody buy municipal bonds? Well, the reason is, first off, relative safety. Generally, municipal bonds have been considered the second safest asset class in the US, or it's been argued that there's, second safest asset class behind United States Treasuries and all of the agency bonds issued by the Treasury. I mean, they have the full faith and credit of the municipalities that are obligated to repay. Cities like Los Angeles, the state or the state of Massachusetts. These have large tax bases. These are municipal entities that have strong populations and strong demographics and ability to pay. The difference between the stock investor versus the bond investor. The stock investor, his or her potential is unlimited. The stock could go from $10 to $10,000 or to zero. stock investor is looking for growth. The bond investor is looking for something completely different than the stock investor. He or she is looking for return of principal, safety of principal, predictable income, and in the case of municipal bonds, tax-free or tax advantage, depending on what jurisdiction the resident or holder of the bond lives in. One of the strategies that we use for uncovering value for our municipal bond portfolio business is looking for municipal bonds that have insurance and where the underlying name, the issuer have a little bit of a story attached to it. So we're a big fan of Chicago's bonds, but only when they're insured. Chicago's bonds when they're insured by the likes of Assured Guarantee, ticker AGO on the exchange. These guys have $12 billion, approximately $12 billion of claims paying ability. While the rest of the world is potentially shunning Chicago's insured bonds, we find that there is, in fact, a lot of value there. Some of my favorite insured bonds are insured by Berkshire Hathaway's Assurance Corp, BHAC. It gets me all tingly to buy a municipal bond where I have some sewer authority or some major city backing the bond, and I have Warren Buffett's Berkshire Hathaway on top of it. So municipal bonds are considered one of the safest asset classes because from 1970 to 2015, the default rate was less than 0.1%. I repeat, less than 0.1%. Why do our clients buy municipal bonds? Relative safety, predictability of income, and tax-free income. Federally tax-free income, and depending on what state or jurisdiction you live in, state tax-free as well. You have a Republican governor, a Democrat-led state legislative body. These guys didn't pass a budget for almost 2 years. You got structural deficits. Chicago's it's like a slow-moving train wreck. You know, you can ride along the train for a little while, but you know that you probably don't want to be a long-term investor if the train keeps staying on the track like it's on. But today, Puerto Rico we have a $74 billion in debt for around under 3 million residents. 74 billion for 3 million. There's no way those people can repay it. After 08-09, Puerto Rico, year after year, they ran structural deficits. While much of the continental United States rebounded after the recession, Puerto Rico didn't rebound. Manufacturing that was there prior, it was phased out during the Clinton administration. There were special incentives for drug manufacturers, pharmaceutical companies to come to Puerto Rico. It changed. And post 08-09, there was no recovery. High unemployment, outflow of residents year after year in Puerto Rico. Puerto Rico's pension fund is 6% funded. So for every 100 cents that they owe to retirees, they have 6 cents on the dollar in actual assets. That's the kind of stuff that keeps me up at night. PRASA, P-R-A-S-A, the Aqueduct Authority. It's something like 40% of the water bills go uncollected and paid. How can you run a government? How do you expect to repay the bonds? The Electric Authority, which was almost 80% of it was knocked over and part of it blown into the Caribbean. They give away 24% of their electricity and they too don't collect on bills. You have an epic fight between the general obligation bondholders and the sales tax bondholders, both arguing under contractual obligations made by the Puerto Rican government based under the Constitution of Puerto Rico that says that they will use every available resource to pay these bonds. And you have this epic fight going on between who's going to carve up the pie. Well, those are the situations we want to try to avoid, or understand the scenario well enough to opportunistically invest. Puerto Rico, it's been the craziest asset class here in the start of 2017. It's up nearly 100% in the first several months in 2017. So what's going on really is why you have municipal finance under attack in hotspots. I believe that municipal finance is implicitly healthy. I believe that with solid coverage of debt service by most municipalities, again, where less than 0.1% over the last 40 plus years, the default rate has been minuscule. The asset class is safe, but there are outliers. And in order to avoid the outliers, as active portfolio managers, that's what we're looking at. Right today, New Jersey, Connecticut, Illinois, big states, if they don't turn the ship around here pretty quickly, there's going to be a problem. Everybody reads the big media picture, Atlantic City, CCC rated, casinos leaving, teetering on the edge of default. Atlantic City is the poster child for bad New Jersey. New Jersey is ultimately a very wealthy state. And do I think that they're going to be able to right the ship? I sure hope so. And do I feel comfortable investing in New Jersey bonds? The answer is a qualified one. Some I do, some I don't. It all depends upon what the revenue stream is. There are plenty of very wealthy, strong communities all scattered throughout New Jersey that their bonds are relatively bulletproof. It's when you get up to the state level and you're dealing with pensions and you get farther and farther away from the well-funded school districts that I worry. So the answer in the long and short is yes, I do think New Jersey will turn it around, but we are keeping a cautious eye on how they're dealing with their pension issues. I'm ultimately going to be watching for what percentage of their debt what percentage of their general fund is being used to service that debt. Illinois' pension fund is only 40% funded. New Jersey is 49% funded. The metric is that if you're at 80%, actuarially, that's considered healthy. When you're half of healthy as a major borrower in the municipal bond market, it is cause for concern. Well, my outlook for Illinois particularly is that if saner heads prevail and the politicians can work it out and they can get on the right trajectory with their pensions, raise taxes, not have outflow to other more business or tax-friendly states, that they can turn the ship around. I think that we have to continue as bond watchers to keep an eye on Illinois. I mean, you have the public school system in Chicago is seemingly a hand-to-mouth borrower, And that's what this is all about. If you have a sane balance sheet and you don't persistently run structural deficits, the capital markets, the muni bond market is going to lend to you. But if year in and year out, you're running structural deficits and you're continually papering over them with more and more debt, ultimately the music's going to stop. And I don't want to be the one who doesn't have a chair when the music stops. We got a little too close to the sun in Connecticut recently. Hartford was, Luke Bronin, their mayor, he was out putting out press releases that the city had hired bankruptcy counsel, and they definitely threatened that they were getting close to insolvency. Ultimately, they found a way, and just recently here, the state of Connecticut has agreed to assume in some fashion or back the city of Hartford's debt. So I think that ultimately municipalities, the big stick that keeps them from walking away from debt is they need to be able to access the capital markets. And if you can't access the capital markets, then you're not going to be able to finance those capital needs that you need over time. Municipalities aren't sitting with hundreds and hundreds of millions of dollars on their balance sheets sitting in a bank account. They need to borrow that money and repay it back over 30 years. It's a loan. It becomes amortized like a home mortgage. California looked like New Jersey after 08, 09. We were pretty concerned about California the same way today that we're concerned about Illinois and New Jersey. California, it was looking a little bit frightening in muni land. And ultimately today, California has had financially, they're running at a surplus. The vast majority of credit upgrades versus downgrades have been to the upside. So California has from a fiscal standpoint, has made a complete resurgence. Remember, California, their bonds are very much in demand. It's a very wealthy state with a very relatively high tax rate. So their bonds are in demand, and we're seeing generally more upgrades from S&P and Moody's than downgrades for the state of California. I mean, gosh, over 25 years, I've seen stupid ass deals. Stupid. I mean, muni bond deals where you take some bond developer, banker decides that it's a really good idea to go down to a southern state. I won't pick on Alabama, but somebody proposed a great idea about a bunch of years ago to take dead chickens, and they were going to raise a bunch of millions of dollars through a public offering. I mean, there's tons of bad stuff that gets filtered out in the muni bond market that never sees the light of day. But there's always, the boondoggle that you remember, the stuff that you said, either you invested in it or happily avoided it. Fortunately, today we try to avoid as many of those as we can, but where you're turning dead chickens into dog food, and you're requiring rural farmers to go ahead and rent a freezer at the back of their farm to collect the dead chickens through some government entity in Alabama, and the government entity is picking up the dead chickens and going to turn them into dog food, and the revenue from the dog food is going to repay the bonds. You know what? That's not even a slow-moving train wreck. That's a disaster. One of the bond deals that absolutely tickles me today as being the worst muni bond deal that I've ever seen. And it's interesting because I hear about Edinburgh, Texas. I see it in the news because it's right on the border of Mexico, and I'm not going to get into politics. But what I find really fascinating is a bunch of knuckleheads in the muni bond business, probably a decade or two, I can't remember. But the basic premise was that the folks that were seeking freedom coming across the border from Mexico, the muni bond deal was premised on the idea that folks coming across the border were going to take a water ride at the water park, and the revenues from the water park were going to repay some type of industrial development revenue bond in Edinburgh, Texas. And obviously, the folks coming across the border in Mexico, they're not coming to take a water park ride. They're going on to other things. Don't invest in what you don't understand. Don't invest in novel concepts. We, as portfolio managers, are going with the tried and true. Municipalities have the ability on their general obligation debt to raise ad valorem property taxes unlimitedly to pay the bonds off. We're looking at strong revenue sources from user fees, tolls, taxes, sales taxes. Muni bond finance that is backed by the sales tax revenue of a particular financing district. Those are on my do avoid list generally. Why? Amazon. Amazon has taken the model for retail, and everybody knows it's turned it on its head. So why would we invest in commercial development within these tax financing districts if many of the underlying retailers from whom sales tax is collected to support district finances, why would we invest in bonds where they're under assault by online shopping and Amazon? So that is an area that we are closely watching. One of the things that keeps me up at night besides credit is duration. Bottom line, the pundits have been calling for interest rates to rise for nearly a decade. Ultimately, I believe that interest rates will rise and that clients need to protect themselves against rising interest rates. One of the ways to do that is to keep duration fairly short. We use a strategy called kicker bond investing. Kicker bonds have an outsized, supersized coupon relative to where bonds are being issued today. It's an older bond. It's already been issued and it's coming up upon its first call, whether it's a month or a year or 2 years away. What we do is we attempt to get a yield for the portfolio that is commensurate or equal to what the portfolio would get in a money market for the same period. If the bonds don't get called, the yield kicks up because the bond stays outstanding. So the longer that a 5% coupon can stay outstanding month over month and year over year, invariably the client portfolio should outperform other market bonds.